Welcome to another week here in December during my favorite time of year, the Christmas season. Hope you had a wonderful weekend and are looking forward to this week and, of course, the season and everything that goes along with it. But without further ado, let's dive into what's going on this week with markets. Uh, it's a big week. It's inflation week. So tomorrow we have the consumer price index, that's the CPI, and Wednesday the producer price index, PPI. PPI stands for the basically the wholesale cost of inflation, wholesale goods, manufacturing side of things. And the consumer price index measures major urban areas in the country and what's happened with inflation. So, market consensus is that it'll be pretty flat. Actually, there's not a whole lot of consensus out there. Well, there is a lot of consensus. The consensus is they don't think anything's going to move much. So they think the headline is going to potentially come down a little bit from 3.2 down to 3% as far as the headline year over year inflation number. And the core CPI, which is the measure that the Federal Reserve prefers because it strips out food and energy, which they consider to be too volatile to include in there and on a long-term basis. They think that that core is going to potentially go from 4%, where it was in the previous month, up to 4.1, maybe even 4.2%. So overall, let's hope the core just stays right there at 4, right? Or if we get a 3 handle, that would be even better. And it's possible that could happen because rents and rent equivalents are such a huge part. If you recall, it's like 43 to 44% of the overall number is rents and rents equivalents. And that is a lagging factor in the CPI, the core CPI and the headline CPI. It's a lagging factor. It takes a while, right, for people to get out of leases and renew leases and see some of those numbers come back down to earth from what we saw over the past couple of years. So that could possibly, honestly, bring us down a little bit or at least keep us flat. The hope is if we can see a 3 handle, 3.9 on that core CPI, that would be really good. That'd be a psychological thing more than anything. But if you have a 3 handle on that number, that may be a head turner a little bit for the Federal Reserve and the markets to say, okay, things are continuing to improve a little bit better than expected. So we'll see. Expectation flat, hopefully slightly better, and we get that core number into the threes, and the headline number in the straight 3% range, or possibly 2.9 would be great. But I think 3 to 3 and 3.2 right in that range. So we'll see what happens as the market expects things. Of course, markets can react differently. Even if there's an expectation, that can cause markets to react negatively because okay, it was just an expectation. But if it's better than expected, you could get a huge improvement. If it's worse than expected, other way around, right? Go the other direction. So it'll be interesting to see. So let's take a look here at the charts here. I'll show you what's going on. The universal mortgage-backed security chart is what I have pulled up here. And right now it's come down a bit. The price has come down a bit since Friday. As you can see, we're hovering right above that 200-day moving average and a Fibonacci technical level of support right there, the 38.2% line, 101.633. So we're hanging in there. Hopefully we can keep it above that. Technical levels mean nothing, of course, if inflation numbers come out wildly one direction or another. Right? It'll continue to either move higher, which would be good news for interest rates, or fall through if we get bad news on the inflation front tomorrow, especially. And by the way, the CPI report, there's a little bit more weight to that in the market than the PPI report. So PPI is kind of a confirmation of what's going on with the CPI, but the CPI is really tomorrow's headline, and core CPI numbers are really what's going to be market movers one direction or the other. Or not, right? Or flat, and you kind of see where it is. As long as we stay above this 200-day moving average, we'll remain in this level, in this range that we've been at, which has been a super nice improvement, right? Since the middle of October, get some dates down here. Since the middle to end of October, seen interest rates improve around 1%, right? Since that time frame, which is a great holiday gift. This particular chart goes back 3 months. Let me show you what's going on here, going back a year just real quick so you can kind of get a bigger perspective. So going back a year, we're still at lower price levels than we were. We're basically at the same price levels we were back in the middle of the summer, right? July, August timeframe. We're not as good as we were back in the spring. So interest rates are a little bit worse, as you probably know, than they were back in the spring. But we've had a major improvement since October, and hopefully with continued improvement in the inflation numbers, it will continue to improve. Now, last Friday, we had an employment report, and unfortunately, the unemployment rate dropped 0.2%. And the jobs numbers were basically in line, slightly, basically in line with expectations on the BLS report. So it wasn't, as you can see from the chart I was showing you there, not a huge market mover last Friday. We were hoping for a weaker jobs report nationwide to show the Federal Reserve that they're making progress, so they don't have to keep the rates as high as long, and they could potentially start cutting rates earlier. But who knows? They may have to keep them longer. We don't know. A lot will depend here this winter and what happens as to whether or not they keep rates where they are, or do quantitative tightening, or a combination of both coming into next spring, or if they push it into summer or fall. Who knows? 10-year Treasury, again, this is the opposite of the universal mortgage-backed security chart, right? So this is not price, this is yield. We want to see the yield fall. That means rates are falling. We've kind of gone as you can see here, gone the other direction slightly for the last couple of days because of that unimpressive employment report on Friday as far as the bond market is concerned. And today we're kind of hanging in there, but there's a lot of room here. Let me see if I can zoom in so you can see this slightly better. There's a lot of room here between the 200-day and the 100-day moving average. So it could go either direction. It's stuck in the middle of a wide range here. So yeah, tomorrow could be quite market moving depending on what happens with that report, either direction. Hopefully, of course, we see it continue its downtrend here because we've kind of broken out of that downtrend pattern or channel at this point as of Friday and then today. So that's where we're at. Hang in there. Have a great week. Enjoy the Christmas season. Talk to you soon.